Hi there, thanks for joining our class today on frequent 1031 exchange mistakes and pitfalls to avoid. My name is Kayla Farking. I am Vice President on the Western USA for Leader 1031. We are a national qualified intermediary and are available in all 50 states. So I want to begin today quickly just with our disclaimer that we do not give legal tax advice, and moving on. So first and foremost, what is a 1031 exchange? For the tax code, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment purposes if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment purposes. Now, granted, that is a mouthful. So in basic terminology, in a 1031 exchange, you sell real estate held as an investment and acquire more real estate held for an investment. In a traditional exchange, you would focus on maybe just focusing on the seller that did not want to perform an exchange. So that would be a traditional sale, excuse my terminology there. So traditional sale, the taxpayer sells investment property, it's like a general sale, and receives money, right? So they receive cash. This creates a taxable event. In a 1031 exchange, the client or taxpayer sells real property and receives more investment property through the use of a qualified intermediary. That's who we are at Leader 1031. In this case, they defer capital gains taxes because they're not touching the cash, right? Anytime you collect money, which is classified as actual receipt of funds, there's a taxable event. Now, in my opinion, this is the last and greatest tax code available to real estate investors. Each year, we are on the chopping block, believe it or not, to be eliminated or capped in certain capacities within our revenue rulings, regulations, and procedures. However, we're still going strong. 1031 or IRC, Internal Revenue Code, Section 1031 of the IRS ruling was created in 1921. So that's over 102 years of the tax code in existence. Now, obviously, we've had a lot of changes, restrictions, private letter rulings, which is also known as a court case, that have indicated some rules that were lenient on exchangers and some that were a little bit more stringent, right? So when we're focusing on reasons to exchange, who are we targeting? Now, these are the clients that have maxed out on depreciation. They're tired of owning property with several partners, right? Tired of being a landlord. Maybe they want to buy something larger, a securitized investment, and sell those residential properties they own. They want to relocate. That's a big one since COVID. Leveraging tax deferral benefits, improving their cash flow, and diversifying or consolidating their real estate investments. Now, what's neat here is you can have a client that maybe owns 3 or 4 properties. They can combine all of them in what we classify as a multiple property exchange, take the entirety of those proceeds and buy one large property. So lots of unique tools here in utilizing this tax code structure while redeploying their entire investment from real estate to more real estate. This leads me into pitfall number 1, closing the sale of the relinquished property without setting up a 1031 first. This one just really, really pains me. We get these calls often. Call it a Friday, you closed escrow with your client, you received your commission check, it's going to be a great weekend. You call me, your qualified intermediary, Kayla Farking at Leader 1031, and say, hey, Kayla, it's Monday morning. It's been a great weekend. My client wants to do a 1031 and we closed Friday. Keyword there, and phrase rather, we closed Friday. Once you have closed escrow and the burdens and benefits have transferred at a recording phase to the new buyer, there's no possibility whatsoever to set up a 1031 exchange. Okay, you can set up a 1031 exchange with Leader 1031 last minute. We can set up a 1031 for you the same day if we receive docs by noon. Okay, let's talk about that discussion as well. If you ever have a non-owner occupied property, be sure to have that conversation right out the gates with your client. Hey, are you familiar with a 1031? Do you intend to buy more real estate with the sale proceeds? Well, I have a solution for you. This communication not only allows your client to know your education level, but allows you to potentially double end a deal, be the listing agent and represent them when they're looking for a replacement, in addition to saving you time and potentially blowing what could have been a 1031 exchange transaction. I'm sure you've seen this within the MLS often. This is what we classify as a cooperation clause. This is placed on a property held for sale, what we classify in that term as a relinquished property. So the buyer is aware that 1031 is in play, or buyer is aware that seller intends to perform a 1031 at no cost to buyer. Different verbiage that I'm sure you've seen in there, as long as there's a cooperation clause in place. Currently, I know there's that SIE, right? Seller's intent to exchange form in the RPA zip form package for CAR. Gosh, I'm realizing how many acronyms we have in real estate, but make sure this is somewhere, whether it's in your RPA package for your contract, there's another one, or within the MLS, right? This is another visual here of what it would look like, or what you've seen on a cooperation clause on replacement, maybe on an offer that you're submitting where the seller is unaware that your buyer is a 1031 buyer. Now back to that pitfall, right? Setting up the exchange, just a quick review of that timing and how it looks in the transaction for those of you who are not very familiar with the timing. This is crucial per the tax code. You start out with your exchanger, also known as your seller. You put your sign in the ground, you get them all cash offer, 7-day close, right? Best possible deal. And within that offer that comes in, you call Leader 1031. We set up a segregated bank account for the destination of those sale proceeds and create a document known as an exchange agreement in addition to an assignment. The assignment indicates that the seller or the taxpayer on title is assigning Leader 1031 to receive sale proceeds at close. Those are the two components we have to have prepared prior to close of escrow. So eliminating that issue, right? Once you've set that up, we're ready to go. We verify okay to close with escrow, and at close, those sale proceeds are wired into that segregated account held by Leader 1031 on behalf of our exchanger taxpayer, known as your seller. We hold those sale proceeds within certain regulations and restrictions of the tax code. You find them replacement property and request, hey, Leader 1031, I need my sale proceeds to buy this replacement property. On behalf of the taxpayer, we wire those sale proceeds over to the new escrow as the buyer's representative and direct deed title back. So this is essentially a circle. Obviously, this visual is more of an oval, but when we're looking at the timeline, where do we come into play? We come into play during the sale of the relinquished property. Always be sure to contact your client's qualified intermediary prior to close of escrow. Those time requirements at the bottom. Day of close begins a 45-day identification period. Identifying replacement property is a formality that is within the tax code. Leaning in on that term, we have a form for the formality. This form goes out to the seller or the exchanger for them to write down the addresses or assessor's parcel numbers, the APNs, of certain real estate held for an investment for replacement properties. After day 45, they have an additional 135 days to potentially close. Now, that doesn't mean they have to use the entire exchange timeline of 180 days. I'm sure you're thinking, how did you get to 180? 45 plus 135 additional to perform gives you a total of 180 from start to finish. So while we're in this transaction in the beginning to avoid that number one pitfall, these are also crucial timeline requirements in place within the tax code that your client will need to know. And that ID, as mentioned, we have to know the APNs, the address, unambiguously described, and we must receive it, I can't stress enough, on the 45th day at midnight, okay? No later. Diving into pitfall number 2, not understanding requirements for full tax deferral and what are partial exchanges. Okay, so for full tax deferral, investors should 1, reinvest all the net exchange proceeds. So that's the sales price less your closing costs, right? Commissions, and we'll get into title transfer, the things that apply and don't apply. And then number 2, have the same or greater amount of debt on replacement property. So my little jingle and takeaway here is, what's my buying power? To my realtor, they're going to ask you, well, what do I need to buy for full tax deferral, Mr. Realtor or Mrs. Realtor? Well, number 1, you need to have your net plus debt. Always remember that takeaway, your net plus debt. The debt does not get eliminated. It has to be replaced, okay? The only way an exchange or taxpayer can eliminate debt from an equation is by 1, taking a hit on capital gains on the amount that wasn't replaced, or 2, offsetting their own debt with cash. So let's say someone sold holding $100,000 in debt. They could go ahead and pull $100,000 from their savings account and use that on their behalf to replace the debt, okay? Now, cash can be added, as I mentioned, and you can also do a partial 1031 exchange. So diving into a visual here of equations and what that would look like for your client. Let's talk about a scenario. This is your client that owns a property and is selling it for $900,000. They have a mortgage on that property of $300K. The cost of that sale, aka closing costs, is around 60 grand. That means the net equity that will be wired at close to Leader 1031 is $540,000. The rest is all paid off, right? You go ahead and find them a replacement property in the amount of $1.2 million. So they're going up in value. Well, we look at our 2 bullet points above. 1, did I reinvest all the net exchange proceeds? Yeah, I asked Leader 1031 to wire over the 540. Check. 2, did I acquire property with the same or greater debt? Well, they talked to their lender and went up in value from the $300,000 to $660,000. That got them to that purchase price of $1.2 million. In this case, bringing in a term here, there is no boot. Boot is anything that's excluded from real estate to real estate in a 1031 exchange transaction. Yes, it's a funny word, I know. Another takeaway for remembering here, tool, you pay taxes on really nice boots, okay? We all love shopping. This is SoCal. So when we're looking at our boots, we know that we pay taxes. Anytime you're touching something like on your feet, cash or debt in that capacity, that's not real estate. That amount could be taxable. And this is where we dive into what a partial 1031 exchange looks like. So on this screen, I've updated the same seller at 900, debt in the amount of 300K. The closing costs were 60. That leaves that 540K to Leader 1031. The replacement property you found them was 700,000. Now, right off the bat, my brain goes to 900K minus 700K. Oh, well, I can assume that this person has 200K in boot, meaning they'll be paying taxes on 200,000. However, that's not the case. So looking at this pitfall, is this person going to utilize a full tax deferral method here? No, but they can use a partial exchange method. They decided in this equation, when you found them a replacement property for 700,000, I'm going to ask Leader 1031 to wire over 440K. We went ahead and we did that. That leaves a shortfall of 100K cash. They're going to talk to their lender and obtain a loan in the amount of 260K. That is a shortfall of 40,000 in debt. The combination of 100 plus 40 gives you 140,000 in taxable boot due by the exchange or taxpayer between them and their CPA. So this is a neat formula, and a lot of clients are preferring this method to have some liquidity on hand and also use that nesting egg to reinvest into more real estate, hold it as a rental, and collect rental income. So this is a best of both worlds scenario. Diving into pitfall, went ahead there. Pitfall number 3. Selling or exchanging into a property that is not held for investment, use in a trade or business. Now, in 2018, this tax code structure of IRC Section 1031 transitioned from real property and personal property exchanges into strictly real property. What that means is you cannot exchange from a commercial building into a business. You cannot exchange gold into a boat. It strictly has to be real estate held for an investment, which benefits everyone at OCAR. Okay. Now, what property is excluded? Principal residence, property held for sale or dealer property. Those are flips, right? Stocks, bonds, here's flips at the bottom too, REITs, interest in a partnership, LLCs, right? So all of these, when we look at a REIT, a real estate investment trust, you cannot exchange into that because you're buying shares of it. The REIT as an entity owner then can own real estate as a structure, and we can do exchanges on behalf of the REIT. But our exchanger as an individual, your client cannot exchange into that. Same concept in a partnership. Okay. Now, what is qualified? That original statement from the tax code: any relinquished property held for productive use in a trade or business or investment exchanged for replacement of real property held for productive use in a trade or business, right? Visually, a commercial building. This is what we can exchange like kind. I can take maybe my 20% ownership in this commercial building and exchange into a Delaware statutory trust. A DST would allow me a fractional or beneficial interest of this small piece of pie of this building. I can exchange my investment of this building into agricultural land, vacant land. I can go from my land into a vacation rental. I always stress on how much I love Colorado. So say let's exchange into Beaver Creek. You own that investment vacation rental for 2 years. You exchange out of it into oil rights, mineral rights, windmills, cell phone tower easements, and my personal favorite here, duplexes, triplexes, or fourplexes. Now, these are unique in nature because we have a lot of inventory when it is available, but we have a lot of real estate inventory within our area of SoCal that includes duplexes. Zoned R2 properties where maybe the front house is a primary, the back house is rented. When you do an exchange, whether that's a duplex capacity, live in one, rent the other, live in the front house, rent the investment, the small granny flat or ADU, right? At that time of sale, you can utilize IRC 121, which is primary exclusion on capital gains taxes for single filers in the amount of a quarter, so $250K. Married filers, $500K. The other portion can be exchanged for full tax deferral. So we call that a split treatment. All of these that you see on your screen are essentially in the ground or something structured to the ground for an improvement and creating or held for productive use, right? Creating capital. So these are great options and visuals for takeaways for maybe the client that is hesitant to list with you, that is focusing on maybe where am I going, right? I don't really know what to buy. Why am I going to list this rental and buy another rental? Well, let's first focus on landing that listing and giving them opportunities of what's ahead. Pitfall number 4, using a person who is considered disqualified as an intermediary. So a qualified intermediary is a non-disqualified agent to the taxpayer. Non-dis, we look at 2 negative words that contractually together make a qualified, a positive word. When we really break that down from legal jargon, the basics are we have to have no relationship to that taxpayer within the last 2 years for our fiduciary representation, right? So this person cannot be an employee, cannot be an attorney, an accountant, Unfortunately, can't be one of you. It can't be a realtor, an investment banker, a broker. Can't be mom, right? You can't have a family member hold your exchange proceeds. This needs to be a qualified intermediary, someone that focuses on the segregated account holding, operating on that assignment, and utilizing an exchange agreement in nature for all of these transactions. So what do we prepare? What is Leader 1031's job, right? What do I do behind the scenes when I'm not educating? We create that exchange agreement, assignment agreement, which I covered, the notice of assignment. Now, this is part of our package on the relinquished sale. Remember, the relinquished is the property being sold. So there's an assignment, right, where the seller is indicating Leader 1031 to come in and be the seller on behalf of our exchanger to hold the sale proceeds. The buyer in that transaction has to sign off on that one-page form at the closing table with their escrow agent, okay? So they need to be in the know. Exchange account forms, any wiring, W-9s, IDs, you name it. We are very, very secure in preparing these segregated accounts, and all of our information is private. So we also include our detailed closing instructions to the escrow company, right? They need to know where to send the money. As we roll into about halfway here at pitfall number 5, this is a daily struggle. Now, I have so many questions where people call in asking for tax advice. So the pitfall is not consulting with a CPA tax advisor before closing on the sale of relinquished property. I can't stress this enough, that people will call and ask, can I do this? It was my primary for a year and then I rented it for 6 months. Can I exchange? Well, the basic terminology would be, well, based on private letter rulings and court cases, potentially no, but let's consult with your CPA in that example, right? Make sure that your client has a legal tax advisor. Every single ownership entity on title and how they've held property and the history of that ownership is different from the next. So again, we do not give legal tax advice. We always stress for our clients to talk to their CPA unless it's a very logical, straightforward point within the tax code that is public knowledge for us to discuss. Pitfall number 6, not handling partnership or LLC issues properly. Anytime you have a listing, always speak with your title rep, always talk to escrow, you know your team, right? So be sure to pull that prelim, understand how vesting is. Hopefully your seller has a deed, right? A lot of the time people will call and say, I'm doing an exchange. We ask who the entity is on title and it's an LLC. LLCs can be prepared in 2 different types of ways. One is a sole member LLC. That is a magnifying glass entity. And what I mean by that is it's Kayla Firking LLC, and I'm the only member. I'm sole member. If you look through that LLC with a magnifying glass to see who the taxpayer is, it's Kayla Firking, right? So that is classified as disregarded. A disregarded entity, because the LLC is essentially disregarded when we use that magnifying glass in Kayla Firking files. That means I can go ahead and sell property A and buy property B as Kayla Firking, an individual. That's the same taxpayer. Scenario 2, if there is an LLC on title that is regarded, say there's 5 members of that LLC, and only one of those members does not want to sell. This is creating an issue because that LLC is the owner and the entity that sells needs to be the entity that acquires. The best case scenario, if you're working with buyers and they intend to go into business, right? Lots of loose terms here, but they go into business or they have a business partner on a purchase. It's always best to set up a TIC or tenants in common structure where maybe Kayla Firking and my brother, Dax Franklin, can go in and we're now 50-50 tenants in common. We own the same structure, but only 50% each. That way, when we sell, we can both go our separate ways. When the LLC is regarded, if we were both members of that LLC and I wanted to hold and he wanted to sell, that creates a major problem because anytime a member cashes out, it's distributed to all members and all members are facing taxes, right? Capital gains. Now, leaning in more on that entity, right? Whoever is on the vested deed or title on the relinquished property must purchase in the same capacity, right? So we hold it the same way. When I gave that example of a disregarded LLC, yes, if Kayla and Trevor, my husband and I, we own in our trust, we could essentially buy as individuals because again, the same taxpayer. Those are very big takeaway points, especially when you're creating your offers going out, responding with the correct entities to save you paperwork and really look like you're savvy and professional, knowing what you're doing and knowing who the taxpayer is that you're working with. Pitfall number 7, lucky number 7. We're almost there. So not evaluating the entire exchange transaction on both sides of the exchange. So we always laugh about this in my family, but it's a true statement. Everyone has a WIFM on their forehead, right? What's in it for me? Whenever you're sitting at a listing appointment, you are the best type of people as far as realtors in the relationship aspect, getting to know your client. So that WIFM is indicative of where someone is going, right? So maybe your client has this dream of owning a coffee shop. Maybe they have a dream of owning land in Montana. It's a big one, right? Go Kevin Costner. There's so many directions that they can go into, right? So when you start evaluating the timing and where they want to go, it really helps you tee up the relinquished property transaction, right? So not looking for replacement property early enough in the transaction is daunting and stressful when you closed escrow on the relinquished and you're only limited to that 45 calendar day timeline to identify formally. So that's a month and a half that you have to find replacement property, right? We know right now that there's very low inventory, which increases demand. So with less inventory, that can also be daunting, right? It's adapting to the challenges of the current market conditions when inventory is low, right? So we need to be ahead of the game, looking ahead first and what's next. Now, as we focus on this, a really neat tool that I always stress to my personal clients is, hey, listen, you can be in contract with both the relinquished property and the replacement property at the same time. You can even make an offer on the replacement property prior to closing on the relinquished property or even listing it. All we need to do in this delayed exchange structure is focus on a domino effect, where the relinquished property closes even the same day or before, a day before the replacement property. We need to free up the sale proceeds, right? The cash. So relinquish needs to close first. So the cash is available held by Leader 1031 to fulfill a purchase on behalf of the exchanger. So again, you can be in escrow with both at the same time. Now here's closing costs and focusing on what's ahead to know that buying power, right? So again, on this last pitfall, what do I pay and what's included in closing costs? And this is a good takeaway for realtors as well. So exchange expenses. Exchange expenses are fees, right? So they're reduced on part of that closing cost. So you have the sales price. All of these are reducing that net equity. Brokers' commissions on both sides, exchange fees, transfer taxes, escrow fees, recording fees, title insurance, attorney. We have a lot of attorney states where people are exchanging into or out of. So all of these are included in a 1031 exchange transaction and classified as closing costs. So meaning they come out of the sales price, right? Anything else you're thinking of? Appraisals? Nope, not included. Basis points, buying down, not included, right? Now looking ahead at capital gains, why would my client 1031 exchange? Well, one, they have depreciation recapture tax on their gain at 25%. So if your client has depreciated $100,000 on their asset, their rental, over the course of ownership, right? That would be 25 grand going back right off the top. Net investment income tax at 3.8%. Federal capital gains taxes between 15 or 20%. Okay, this depends on anyone's individual bracket. And last but not least, the applicable state tax rate. Here I have 0 to 13.3. And this slide, as some of you may know, that our headquarters operates on the East Coast out of Massachusetts. So when we're looking at this, to give you just a visual of other states and what they pay, Massachusetts is at 5%, and lucky California over here with all of our rain, no sunshine, is 13.3%. So again, no legal tax advice, but when we're looking at these numbers to prepare and look ahead at what's next, capital gains out of the state of California on average could be between 30 to about 48% on the high end. Always consult with their CPA. We don't know their other investments. We don't know their income. We don't know how long they've held this property for as an investment. We don't know how long or how much they've depreciated. These are CPA questions to get to that exact percentage. So they're aware, hey, if I don't do a 1031, X amount of money is gone. Logically, if you have $1 million in gain on a property, let's go on the low end of my estimate. 30% of that, that's $300,000 is gone or just paid to the government, right? Why not use that $300K as a down payment on another investment? Pitfall number 8, engaging in related party transactions. A taxpayer should generally not purchase replacement property from a family member or related entity that is considered related. So what is considered related? Anyone with 50% biological relations, mom, dad, brother, sister, right? So when we're looking at these people and doing deals, the government doesn't want, or I should say the IRS does not want an exchanger to end up with cash. So if my father, Mike, has an investment property and I have an investment property, I want to exchange into the one that he owns, right? Number one, what's going to stop him from giving me a little bit of a deal on that property? And number two, he also needs to exchange out of his property. If he does not exchange, he's ending up with cash from what I exchanged into, right, as the seller. So he sold, he receives the cash. What is going to stop Mike from gifting tax-free inheritance to Kayla? This is why, right? I know that why always comes up. Well, I don't understand. I need to know more. So that's why. Anytime there is an exchange, and we'll use that same example that I exchanged into his, he would need to exchange out. That is acceptable. Nobody ended up with cash, right? Last pitfall here, number 9. Not understanding reverse exchange or parking arrangements is what we call them in our world, transactions. The low inventory topic. Yes, I know. I'm aware. I've had my license for 13 years, so I understand different economic cycles, and I understand how it can be daunting. While 1031 sounds great, there's no way I'm going to get my client into a property within that 45 days. If that's your mentality, I have a solution for you. A reverse exchange. Yes, reverse. Do it backwards. So one, this creates purchasing freedom. The client has to come up with cash or cash and debt combo to acquire the replacement property first. We have an assignment put into place, just like what we reviewed on the delayed exchange, and we would create a brand new LLC to park like a car, right? Just setting it to the side, parking it, letting it rest there, so that at close of escrow, the LLC is on title, okay? Day of close indicates 180 calendar days in reverse, or 180 going forward rather, for them to sell the relinquished property. Once they sell the relinquished property, maybe they pay off that loan, maybe they replenish where they pulled the savings from, and they have a completed 1031. Now, I know the pushback for those of you that are in the lending game. Well, how is a loan officer going to loan to a brand new LLC? Well, great news. Solution number 2 on a reverse exchange. we can set up the reverse where we park the LLC on title to the relinquished property. This frees up title for a lender to loan to an individual or family trust. Okay, so that's a benefit as well. An improvement exchange. So let's say they're performing a delayed exchange. They sell the investment property. The sale proceeds go to a segregated account held by Leader 1031. And you find them a property, let's say for $800K, and they sold for $1 million with no closing costs. So that leaves $200,000 in that account, right? On their behalf. They could either collect it and hold it as boot, taxable, right? But let's say that property needs a new roof. It needs new foundation. As long as they're improving that real estate, we would then create a brand new LLC to go on title, to hold that title and park title, and the exchanger would draw on those funds, almost like a construction loan, to improve the property. The improvements must be completed within 180 calendar days from the sale of the relinquished, so 6 months in its entirety. In addition to that, if that is the intent of the exchanger, they would need to indicate on their identification the improvements. A built-to-suit exchange, this is building a new replacement property from the ground up. This is rarely used in Southern California based on where we're at for coastal commissions, approving building plans, but this could be someone who potentially uses a portion to buy land and maybe lays foundation, right? So built to suit, build from the ground up, improvement, improve something that already exists, draw on your remaining funds that would have been taxable, and reverse, acquire the replacement property prior to selling the relinquished. Now, highlights of the delayed exchange is what we really focused on our core today and the pitfalls to avoid. Always, always talk to a qualified intermediary, even before your listing appointment. Get in the know, make sure that your client is in communication. We can always set up meetings together, whether it's Zoom, in person, we have educational material, anything you need. Ensure that the sale contract is assignable, right? We talked about what we do as a qualified intermediary. We need to create that assignment. So verifying we have our contract ready to go prior to close. Indicate that cooperation clause, the intent to perform a 1031, right? At no cost to buyer if it's your seller, or no cost to seller if it's your buyer. For full tax deferral takeaway here, remember, you have to 1, reinvest their net exchange proceeds, and 2, acquire a property with the same or greater debt. Again, full tax deferral. If you do go down in value, you're facing capital gains taxes, but only on the shortfall that remains. Okay. The taxpayer must identify the replacement property to be acquired in accordance with the rules of identification within the 45 days. I didn't dive too much into rules, but please call me directly and we can discuss those if you're in need of some more education. The taxpayer must close on the replacement property by the 180th calendar day, right, from the close of the relinquished property, or their tax filing date, whichever is earlier. So when we're looking at that, the takeaway is 180 days from start to finish in the entire exchange period. As this was a recording, my contact information is on the screen here. You can reach me on my mobile at 760-622-7716 or by email at kayla.ferking@leaderbank.com. Again, Leader 1031 is its own operating qualified intermediary. We cover all 50 states and we're here to help you succeed. So anything you need, any questions you have, feel free to reach out to me directly. I appreciate your time, and since it is a recording, there are no questions live. So contact me if you have them. Thanks. Have a great day.